Now it's time to run through a nice practical situation for our subsequent events. Let's begin with what is given in the question. Well, Albert Company is the defendant in a class action lawsuit brought on by customers who claim that the company's products caused injuries. Not good. Not good for you, Albert. The customers filed the lawsuit in August and are suing for $10 million. Albert always maintains insurance, which pays out in the event of successful claims against the company. Now, here's something that we haven't seen before, and we're going to see how it applies. Right? If you've got insurance that will cover a potential loss because of a lawsuit, how does that affect the situation? We'll find out. The coverage for this insurance maxes out at $4 million, meaning, let's say they are sued for $10 million. Well, sorry, not all of that amount is going to get covered. Albert's lawyers advise that it is likely that the judge will rule in favor of the customers, not good for Albert, and that Albert would have to pay around $6 million. However, based on the customer's original suit, the amount could be $10 million. Now, just taking that into account, right? The maximum it could be is $10 million. That's what they're suing for. However, the lawyer, the legal counsel, is saying it's probably going to be around $6 million. Now, our question, if this was a question that we'd see, what should Albert do in terms of the subsequent event when it comes to accruing, disclosing, or doing nothing? Let's use our rules. Let's use our knowledge that we've learned so far and prepare any journal entries as needed. And wouldn't you know it, spoiler, here it is. Here's the journal entry we would need. Now, Albert's legal counsel, they stated that it's likely the judge would rule in favor of the plaintiffs, meaning it's probably reasonably possible, we could say. In this example, we have a range, though. What do we do with a range? As such, we need to accrue the minimum of $6 million as the contingency amount, and the maximum should be disclosed. So again, let's repeat this. What are we doing? We're accruing for, meaning we're actually recording a loss of $6 million because our legal counsel, who should have our best interest in heart, is telling us this is what is likely going to happen. Now, the maximum could be $10 million, so we want to, for the sake of investors, let them know, hey, yeah, we could be paying out $10 million in the future. So there we go. Now, how does insurance play a role? This could be a trick, because if you haven't seen something like this, you may think, oh, okay, insurance is going to cover, right, this amount partially, and we won't have as much of a liability. However, any proceeds from insurance would actually be a gain contingency. So it wouldn't be a mitigating factor against the loss contingency. It would be its own factor of a gain contingency. It would follow those rules. And as such, any insurance proceeds, meaning $4 million of money you get back from the insurance company, that would only get accrued if this actually happened. Once this actually happened, if it does happen, that's when we will receive this money. I think it's a pretty solid question. Great always to walk through some practical examples with all of you. I'm sure you're having a great time and hope you enjoyed. Let's keep moving along. As always, we've got a wonderful graphic here for you, a wonderful way to visualize what is going on. How often do we not know what is going on? Quite a bit. So here I am to decipher it for you. Let's ground ourselves. We've got a year's long process, right? Here's April year 1, here's April year 2. Here's the year-end date. Let's ground ourselves. So it's a 12/31 audit. That's what we're dealing with here. December year 1, this is the end of the year. Now, what is going on in the beginning here? Well, April year 1. Here we're going to examine the latest interim financial statements. Now, this is where I mentioned before, you could do interim testing, which is essentially like before. So instead of waiting all the way to the end of the year and saying, okay, we're going to audit you once the year's over, no, you could audit the beginning of the year. And well, also, this is referring to auditing the interim financial statements for year 0's subsequent events. That's kind of what's going on there. Here we've got our type 1 subsequent event. It exists as of the balance sheet date. So anything here, right, is going to be a type 1 event. And type 1 events happened in, well, in this case, year 1 in the current year, and as such need to be recognized. Now, if you find out about type 1 events in year 2, you should accrue for them in year 1. And then we have our type 2 subsequent events. They did not exist as of the balance sheet date. They're not recognized, so we footnote/disclose them. These are going to be items, right, that we talked about, like lawsuits or, like warehouses burning down. This could happen in February year 2. Then we've got In this case, it's March year 2. This is the auditor's report date when we've obtained sufficient and appropriate audit evidence. And then we've got April year 2. We will talk a few things here, right? So during this period from the end of the year up until the date that we have obtained sufficient and appropriate audit evidence, what are the activities? What are the actions we need to take? Well, we need to examine the post-balance sheet transactions, meaning any transactions made after the balance sheet date. We got to get a rep letter from management, something we know we need to do. We are going to inquire about any new commitments, any new borrowings, any new guarantees by the company, which could lend itself to discovering new contingencies and commitments. What about inquiring about any sales or acquisition of assets? Sure, we got to do that. Any increases in capital or debt, we're raising money in any way, any assets that were destroyed or appropriated. These are all things that we may need to disclose if they're significant and material. Any developments with our contingencies. And lastly, any unusual accounting adjustments, just all items that could affect what we need to do. This is when we are accounting for them in this period right here. Then you've got this period between when you obtain sufficient and appropriate evidence and our issue date. So April is our issue date. Between our audit report date and our issue date, we are going to consider what we find here. We are going to consider, do we dual date the report? This is where this would fall in our process, like we talked about. Do we need to change the completion date, but need to extend audit work? Do we change that, right? Talking about what are we going to do? Are we going to choose option 1 or option 2 from before? And lastly, are we going to mark disclosure as unaudited and keep current report date? These are all having to do with our dual dated options here, right? Just like we talked about, that's what's going to happen. Let's talk about this little box over here, the auditor's responsibility for subsequent events up until, so for issuers, it's up until the issue date. For non-issuers, it's up until the date it's available to be issued. Now, what does this mean? Let's talk about this for a second. The auditor has responsibility. Well, for issuers, let's just think about it. Issuers have a little bit more strict rules because public companies, we're dealing with the SEC. So it's a little more strict. You have responsibility up until the issue date, which is further than the date that they're available to be issued, which, let's say available to be issued, I don't know, is right here. So you see here for non-issuers, you have less time of responsibility that you're taking for, whereas issuers, you have more time that you have to take responsibility for. And lastly, let's talk about what happens after issuance. Well, after issuance, if material items affect the report and there is reliance on the report, we need to advise the client to disclose and reissue the financial statements, meaning, yes, we're going to kind of monitor it. We're not going to actively be auditing them anymore. But let's say we find out that there's this massive scandal in the company or massive action that is going to affect the report. If it's material and people are still relying on that report, well, then we need to advise the client to disclose and reissue the financial statements. And if the client refuses, we need to go above them and notify the board of director of the refusal. And any additional actions the auditor may take, we could notify that the audit report may no longer be relied upon. We could just start issuing statements, right, saying that, hey, no one should rely on this audit report anymore. Go above the board of directors and notify regulatory agencies. And lastly, notify known persons relying on the financial statements. So just getting the word out that, hey, there's something happened. Management should have disclosed for it. They didn't. You can't rely on these financial statements, so don't. Nice little graphic here. Hope it was a nice visualization of this whole process. Another nice example here. We've got nice visualization. Okay, similar type item. Well, here's where we're going to conduct our interim work. As I mentioned, you can do some work before the end of the year. Here, we'll say we have another 12/31 date, right? So this is going to be when we just do some of the work so we don't have to do it later on. Again, that's in theory because in reality, you're just going to have to do a lot of work. It's busy season. That's what they call it, right? So this is where you're going to do a lot of your testing. You see here, physical observation, cash recs, verification of fixed assets, just all your substantive testing. Then we have cutoffs work where we are working for the management assertion of cutoff. We are going to observe and cut off tests for cash and AR in all of our accounts. Then the client's going to close their books, and we perform our year-end work, which is just normal audit work, your normal audit busy season work. This is where you're going to review subsequent AR collections, follow up on confirmation requests, search for unrecorded liabilities, and perform your subsequent events testing. Next up to here, when we get into our report time, before we're going to issue that report, we're going to obtain our management representation letter. In this case, it's going to be dated February 10th at the last minute, right? It's the last thing you got to get, making sure that everything is confirmed and everyone has responsibility up until that particular date. Nice little visualization here for you. If you like it, and if you don't, please tell me. Just tell me, write me a little letter and say, hey, Nick, I didn't like your visualization. And then maybe I'll make another one. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.